The French economy is collapsing. The situation is so bad that the French Prime Minister has stepped down to force the government to take action before it's too late. And if you think that I'm exaggerating, just give it a closer look and you will find out that the situation is way worse than you can possibly imagine. And if the French economy is going to collapse, it is going to check with the entire European Union because France is the second largest European country. And the only country that can save France is Germany. But it's going to cost a lot of money for Germany. So, will Germany save France? Over the last 50 years, the French economy has been running a persistent deficit every single year. 20 years ago, it wasn't a big deal because the deficit was about 3 to 4%. However, since then, it has been growing tremendously, and a 6% deficit rate became the new normal for the French economy. That is something that the French economy cannot possibly afford. And looking at all the estimates for future years, it seems like it is only going to grow. And the lowest estimate is about 6.5 to 7%. This year alone, the interest payments on the French debt will be $67 billion. Yes, if you compare that to the United States, that's peanuts. That's something the United States can spend in a single day. But remember, France is not the United States. The French GDP is a fraction of the US economy. So for France, that's a lot of money. The real problem is that the era of low interest rates is over. If you give it a closer look, you'll find out that most of that French debt was actually borrowed when interest rates were extremely low all across the globe, especially in the European Union. There were periods where the interest rates of the European Central Bank were negative, so France could borrow so much money that it can possibly want it. However, if France had paid off that debt on time, it wouldn't be a problem. But that debt kept accumulating and accumulating and accumulating. And now we have entered a new era of high interest rates. That is exactly what the Federal Reserve said. At Jackson Hole, the chairman of the Fed, Jay Powell, said that from now onwards, the entire world is entering the era of high interest rates. So now you have to refinance that debt at the higher interest rates, which you cannot possibly afford. So based on different estimates, the interest payments on the French debt by 2030, which is a couple of years from now, will cross $130 to $160 billion. That's a lot of money. That's the kind of money that the French government, based on their current economy, cannot possibly afford. And remember, France is not actually developing technologies like the United States or China. France is not the center of artificial intelligence. France is not developing the next ChatGPT or Oracle or Amazon. So France cannot possibly afford that unless France is going to take real serious measures today and will either start growing its economy drastically or will actually increase taxes. I'm not sure how much more you can increase taxes. The entire European Union is heavily taxed. So probably the only option to deregulate the entire European Union so that finally startups will have a room to breathe and will finally some kind of AI companies will come out of the European Union, especially from France. Another problem with that debt is that it is mostly held by public investors. It's not being held by the French institutions or by the European Central Bank, but rather by private investors. So France has no other option but to continue paying off interest on those debts. Otherwise, investors will no longer trust France and they will no longer loan their money to France and France will fall behind. Imagine France, one of the most powerful countries in the world, defaulting on its loans. France is turning into the second Greece. You see, for a very long time, Greek economy has also been running a persistent inflation. Right before the 2008, that's exactly where Greece was, where France is today. After years of borrowing money, Greece found itself in a position where it could not possibly pay off its debts and it was about to default on its loan. But remember, the entire European Union, all of them or most of them use the exact same currency, euro. So if Greece is going to default on its loans, then it will drag down with it the entire European Union. So Germany had to step in and provide Greece with hundreds of billions of euros to save it to prevent the entire European Union to collapse. Since then, the Greek economy hasn't been growing for the next 10 years. There was literally a stagflation of the entire GDP. Finally, you can see that since 2020, Greek GDP is growing tremendously. So if your debt stays the same, while your GDP is growing, then suddenly your debt in relation to your GDP is falling down. But Greece has done a fantastic job. They have hiked their interest rates, they've been much more stricter with their spending, so they regained the trust of investors, and that's why the interest payments on their debt has been going down. Greece fell into the exact same trap. You borrow a lot of money at a very low interest rates, and when the time of refinancing that debt comes and the interest rates are extremely high, that's where the real problem comes. Imagine you are actually making a good money and interest rates are very, very low. So the bank convinces you to borrow as much money as you want. So you borrow all of that money because the interest payments of them are just 1%, which you can afford. If you pay that debt on time, it's not a problem. But then 10 years later, when interest rates are extremely high and you haven't paid that, you have to refinance that debt at the current interest rate, which you cannot possibly afford, and that's when you declare a bankruptcy. So the real question comes at the end of the day, will Germany actually save France? You see, the difference between Greece and France is that the Greek GDP was about $250 billion, while the French GDP is about $3 trillion. So it was so difficult to save the Greek economy that is literally a fraction of the French economy. Imagine for a moment how difficult it is going to be to save the French economy. And if you look at the entire European Union, Germany is the largest, then France is the second largest. So if France falls down, I don't think there will be any kind of European Union. So the question comes at the end of the day, how strongly Germany loves the entire European Union. Now, to understand the problem, you have to understand how the European economy works. So you have the European Central Bank that creates the euro, and then you have multiple European countries such as France, Germany, and Italy that use the exact same currency. Now, these countries, when they want to issue debt, they have to create government bonds and sell them in the open market. And all of them issue the government bonds in a single currency, which is the European euro. And then you have investors on the other side who are buying these government bonds from these countries. So if you have a very strong economy, if you're very responsible, then investors would actually accept a lower interest rate. But if you're irresponsible like Greece was before the 2008 or around 2008, then you're going to demand a very high interest rates. Now France in that position where it can barely afford the interest payments on its debt. So how can we possibly save France? You see, in normal economies where you have one country and one central bank, the central bank will intervene and will start creating money and will be buying the government bonds, which is going to lower the interest rates on those government bonds, which is going to help the government to avoid a bankruptcy. When Japanese government borrowed so much money, the Japanese central bank intervened and started buying all of these government bonds. And that's why even though that Japan has one of the highest debt to GDP ratio, about 60% of that debt is being held by the Bank of Japan. But every time the central bank is creating money, the value of the currency is falling down. So in this case, if the European Central Bank will actually start creating euros and will start buying the French government bonds, it is going to create a lot of euros, which is going to devalue the dollar, which is going to make the German economy weaker, and is going to make the Italian economy weaker, and is going to make every other European economy weaker. So the only way to approve that is for Germany, which is the largest economy, to approve this by the European Union. But there is another problem. That is artificial demand for the French government bonds. Italy is going to say, we also have a lot of debt. Why is the European Central Bank is subsidizing the French debt and isn't subsidizing the Italian debt? So how about the European Central Bank to also create money and create artificial demand for the Italian government bonds so that Italy will pay a lower interest payments? Do you see, it instantly creates a problem for the entire European Union, which leaves us with the second option. And that is Germany stepping in and using its national budget to buy the government bonds on France and create artificial demand to bring the rates down to make it possible for the French government to make its government bond payments and avoid a default. In that case, other European countries cannot possibly say anything to Germany because Germany is using taxpayers' money to finance or create artificial demand for the French economy and for the French government bonds. But it's going to cost the German economy or the German budget hundreds of billions of dollars. The real question comes at the end of the day, can Germany afford that? Germany is actually a very strong economy and they are an industrial powerhouse. In fact, they have one of the lowest debt to GDP ratio and have been very disciplined with their spending. Their debt to GDP ratio is 62%, which is probably the lowest in the entire European Union. But since 2022, the German economy has been suffering. Almost every single quarter was a negative quarter, which means that over the last 3 years, it has been going through a persistent recession. And when you have a persistent recession, we can simply call it a depression. The German economy is in a catastrophe. And that's why the unemployment has been growing from about 5.5% to 6.3%. If you compare it to the United States unemployment rate of 4.3%, that's when you know that Germany is going through a disaster. And it doesn't seem like it is going to be solved anytime soon, because with each consecutive quarter, the situation is getting worse and worse. So it seems like there isn't any kind of easy solution for the French economy to save the French economy. And if the European Union will decide that European Central Bank will intervene by creating money, every single European citizen is going to get slightly poorer. And the value of assets will drastically rise in value because they will be printing so much money to save the French economy. And if you don't want to find yourself poorer, if you want to take advantage out of it, if you want to protect yourself, then maybe it's time for you to start investing. And if you want to know what are the best stocks to buy right now, then check out the first link in the description of this video. That's it for today, guys. Thanks for watching, and I will see you in the next one.